Here at HQ Tax and Financial USA, we specialize in U.S. domestic and international tax compliance. Today, I will talk about tax issues affecting expatriates. Expatriates are U.S. citizens or U.S. residents working abroad. A U.S. resident, known as a resident alien, is a person who either holds the green card or has met the substantial presence test. To meet the substantial presence test, the individual must be physically present in the United States for at least 31 days in the current year and 183 days during the previous 3-year period. Not all years are equally weighted. Instead, the calculation counts all the days you were present in the current year, 1/3 of the days in the prior year, and 1/6 of the days 2 years ago. If you are living in a tax home outside the U.S. on April 15, when your taxes are due, then you are granted an automatic 2-month extension of time to file. A tax home is created when the taxpayer is working permanently or indefinitely in that country. Some of the tax breaks available to U.S. expatriates include the foreign earned income exclusion, the foreign housing exclusion, and the foreign tax credit. Taxpayers can exclude up to $104,100 of foreign earned income in 2018. Earned income include wages, commissions, tips, etc. earned while working abroad, and does not include passive income like dividends and interest. Although not taxable, you still must report this income to the U.S. on Form 1040, Line 7, and file Form 2555 with your tax return. Claiming this exclusion will prevent you from taking certain credits and deductions like the child tax credit. 30% of the amount of the foreign earned income exclusion, which in 2018 comes to $31,230, is allowed for the foreign housing exclusion. This is an exclusion on housing-related benefits provided to you by your employer while you are working overseas. To qualify for either of these exclusions, the taxpayer must be a foreign resident and their tax home must be in a foreign country. An individual can be considered a foreign resident through meeting the physical presence or bona fide residence tests. The physical presence test is met when you are present in a foreign country for 330 days in any 12-month period, and this does not have to be a calendar year. The bona fide residence test is met if you have been a resident of a foreign country for an entire calendar year. If an individual does not meet one of these tests by the time of filing their return, they have 2 options. They can choose to extend their return through filing Form 2350, which may give them enough time to meet one of these tests, or they can file and later amend once they meet one of these tests. To be allowed the foreign tax credit, the foreign tax has to be an income tax or a tax in lieu of an income tax. Income taxes include tax on wages earned while working abroad. Taxes in lieu of an income tax include gross income, gross receipt, or sales taxes. Value-added taxes do not qualify. The U.S. makes sure that income is taxed at least the U.S. tax rate. So, if someone pays a tax of only $100 on $1,000 of dividends received from a UK corporation, and the U.S. would charge $150, the person would be allowed a tax credit of only $100. And they would have to pay the difference of $50 to the IRS. But if $200 in tax was paid on that $1,000 of dividends received from the UK corporation, and the U.S. would only charge him $150 in taxes on that, then the individual is allowed a foreign tax credit of the full $150 of U.S. taxes. To receive the foreign tax credit, you must be legally liable for the tax and you cannot be entitled to receive a refund. For example, if the tax treaty between the U.S. and the UK states that dividends are to be taxed at only 10%, so you should have only paid $100 in taxes on this $1,000 of dividend income, then you would only be entitled to a credit of $100. The tax treaty rates can be viewed on the IRS website. If your income is being overwithheld, you should contact your withholding agent and inform him that you are a U.S. resident in order to have the withholding rate changed for the future. If taxes have already been overwithheld, the only way to get the money back is through filing a tax return in the foreign country. The foreign tax credit cannot be more than the foreign taxable income divided by your total income times your U.S. tax liability. Unused foreign tax credits can be carried back 1 year or forward 10 years. You cannot claim a foreign tax credit for income that is excluded under the foreign earned income or housing exclusions.